So this is session 1 on consolidated accounts, and there are two aims to this session. Firstly, to outline the need for consolidated group financial statements, and secondly, to spend some time preparing an initially straightforward consolidated statement of financial position. This is broken down into three presentations. At least three presentations. The first one is going to be outlining the need for the consolidated group financial statements. So, as the introduction says, many businesses will operate through other businesses. So this is where one business buys the shares or owns all of the shares in other businesses. And so one business will operate through another business. One of the reasons that businesses may well do this takes us back to the idea of limited liability. We know that each business as a company has limited liability. The implications of that are that the owners of the business have their losses limited. So if one business owns another business, then that owning business has its losses limited only to the investment that they've made in the other business. So this can offer an opportunity for one business to grow, but by doing it through a different company, through a different business, the business can grow while at the same time minimizing its risks. So this is the idea of businesses operating through other businesses by one business purchasing some or all of the share capital of another and becoming the owner of that other. So how is that recorded in the accounts of the individual company? Well, it's reflected in the creation of a non-current asset investment. So the acquisition of shares in one other business creates a non-current asset of an investment, and that will be created by, for example, the payment of cash to buy the shares, so cash will go down, or sometimes can be done by the issuing of new equity by the company in return for acquiring the shares of another business. There's probably lots of different ways that this can be actually achieved by a business. So the diagram below gives an indication of how there might be a range of investments that one company might make in other companies. So what you can see is that company A is considered to be the company that has made all the purchases. And company A has purchased 100% or owns 100% of company B, 80% of company C, 30% of company D, and only 10% of company E. So those are our sorts of examples. And they're the sorts of examples that we'll actually look at through the course of the consolidated sessions, though probably sticking with the company B, company C scenarios for much of the time. But I suppose it could be said that these differing degrees of investment give an investor, the parent, the company A, give an investor differing levels of influence over company B, C, D and E. And what we'll see is how these differing levels of influence, because of the differing levels of investment, might be differently accounted for with respect to financial reporting. One of the things that can be different about the accounting is that these investments and the influence create a group of companies. So, a group of companies involves two or more legally separate economic entities. So two or more companies, for our examples, legally separate economic entities operating in substance as if they were one. So this is the idea of a business operating through another business. So there is more than one legally separate economic entity, but in substance, the reality of what is going on is that they are acting as if they were one economic entity. And in accounting, more formally, we say that the nature of that investment may result in a company being considered as the parent company of a group of companies that comprise a number of subsidiaries. So we're talking about parents and subsidiaries here. So it may be that company A is going to be considered to be a parent company. Company B, C, D and E may be subsidiary companies. How do we know? How do we know when a company is a parent and when that parent has subsidiaries? So this takes us to IFRS 10 on consolidated statements, which gives us the clear definitions of how to identify a parent and a subsidiary. And the key idea about a parent is an entity that controls one or more other entity. So that's very similar to the idea of linking to the definition of an asset. An asset is a resource that derives from a past transaction that gives present control, resulting in future economic benefits. So a parent is an entity that controls one or more entities. So a parent may control as a result of the asset investment. And the subsidiary is an entity that is controlled. So it's the other way round. The standard also goes on to discuss what is actually meant by control, and it's the idea that the investor has rights to variable returns from its involvements with the investee and has the ability to affect those returns through its power over the investee. So the parent has no guaranteed return, there is a variable return. But the key thing is the parent can make a difference to those returns because the parent has power. The parent can tell the subsidiary what to do. If we're looking at another example of substance over form here, we're saying what is the substance or the reality of the relationship? Can one company effectively tell another one what to do? Does it have control? So if we are to assume, let us say we're going to assume that the ownership that company A has in company B, C, D and E, let's assume that this links to voting shares. So that would imply that owning 100% of the voting shares of company B implies that company A controls company B. So company A is the parent and company B is a subsidiary. It's also the case that if we are talking about owning the voting shares of another company, then owning 80% of the voting shares of company C would also make company C a subsidiary because the other 20% ownership has no means of directing the affairs of company C. So company A is a parent not only of company B but also of company C because it controls through its voting rights, controls company B and company C, which are both subsidiaries. More difficult, though, is company D and particularly company E. If company A owns 30% of company D, then it's not at all sure that they have control. Do they have the ability to affect the returns through their power over the investee? Well, if another entity owns 70%, if another entity owns the other 70%, it's pretty clear company A has no control. But it might not always be the case. It could well be that the other 70% is split amongst hundreds of thousands of other owners, and so it's possible that that 30% could give control. The key thing about IFRS 10 and consolidated financial statements is that we have to look at the reality or the substance of the relationship. But for our purposes, we will assume that 30% of the ownership does not give control. And in particular, 10% for Company E would not give control. So for our more straightforward examples in terms of ownership of the voting shares, we would say that Company A is a parent and Company B and Company C are the subsidiaries. And that's how we're going to take forward the example. The key thing is about parent and subsidiary relationships. When we have a group of companies, then there are further financial statements required. We require consolidated or group financial statements. So consolidated or group financial statements are a further set of accounts. So we already have the company accounts for Company A, B, C, D and E. There is now a further set of accounts produced only by the parent company. And those further sets of accounts show the group as if it was one single economic entity. So at its simplest, that means we take the company accounts for, in our example, Company A, Company B and Company C, the parent and subsidiary companies, that we take those accounts and at their simplest, we add together the assets, the liabilities, the revenues and the expenses to produce one consolidated or added together set of financial statements. So why do we do that? Particularly, it's to faithfully reflect. So it's all about faithful representation, faithfully reflecting the commercial or economic substance of the relationship. If they are acting as one, should we not present information showing them as one? That therefore means we've got much more useful information for the users of accounts, particularly for the owners of the parent company A, on the totality of the economic resources controlled, on the totality of the assets and the obligations claimed against the parent. And we've got information on the totality of the performance, the total profitability of the parent derived from those controlled resources. And that's important because if we only had the company accounts, in the company accounts, the parent company accounts, the income statement would only show dividend income from all of the subsidiary companies. So the income statement would only record the dividend income in the parent's profit and loss. But the dividend income may not be a good reflection of the profitability of all of those businesses that the parent has an investment in. And the parent statement of financial position. All that shows is the investment under non-current assets. It doesn't show the detail of all of the assets and liabilities of each of the individual companies that the parent has a relationship with. So company accounts do not provide enough useful information to the owners of the group, the parent company's ultimate shareholders, does not provide enough useful information to those users. And so we have consolidated financial statements to provide more useful information to the users and to better reflect the commercial and economic substance of the relationship.